Today's financial technology dialogue is often about a word you don't usually associate with it: democracy, bringing software, data, reporting, testing, and trading to the masses. And it's not just one size for everyone, it's customizable too. At the FinTech Exchange 2015 Chicago event, 13 firm executives spoke during its lightning round. John Lothian News took the best of 2 hours of presentations and condensed it into 3 minutes. Here's how some of those firms are democratizing and customizing technology for all of us.
The democratizing force of technology in the form of internet technologies and the commoditization of low latency technologies means that if you're in professional trading, your competitors have access to the same things you do. So your differentiator needs to move from being about technical expertise to being about understanding the user and the problems that they face. I'd encourage you, in the context of a leveling playing field, build for value rather than just speed and performance. Don't get caught using the same tool repeatedly over and over again. Diversify the tools that you use. And most importantly, value your users more than your product and more than your technology. If they're not successful, then neither are you.
Building for change is also about empowering the clients. It's not just about us. So it stands to reason they'll want to be able to change the apps that we provide as well. And the only way we can really facilitate that is by providing the full source code to all of these apps to our clients.
The last challenge that we came across in this of the last couple months was, how do I take a exclusive technology, one that is, has had a lot of development dollars and by itself costs a lot, and structure a service that tempers the cost down to where I could bring it to the masses?
The estimate industry has historically been an oligopoly of Bloomberg, FactSet, Thomson, CapIQ. These fundamental estimates are used in basically every investment model, no matter your dogma regarding how you like to value an equity or an option or whatever you're trying to do. This is one of the most important data sets to the market at the end of the day. So that model sucks. It's basically 30 years old. What we do is we use a mix of regression and machine learning models to look at the behavior of how people make their estimates, to look at the accuracy of those estimates, to look at all sorts of other characteristics of those estimates. We get higher accuracy. Our data set, about 70% of the time, is more accurate than the Thomson Reuters or Bloomberg consensus. But most importantly here, it's more representative of the true expectation of the market.
So social media is disrupting the capital markets. And if you don't believe me, look back to the Wall Street Journal last week when people were talking about a tweet on Altera being acquired by Intel Communications and the subsequent reaction in the security prices. Social media is the feeling of the pit. So I remember, and I'm dating myself, but they used to pump crowd noise into the trading desk so you could see what the noise was in the pit. That's what social media is. It's really the feeling of the pit, the energy in the pit.
Our primary form of delivering brokerage services to the end client, to that retail trader, to that advisory client, is not through some whiz-bang proprietary front end that we've built out because we think that we have all the knowledge and can deliver all things to everybody. We provide, through our API, an engine that powers trading across applications. We're disaggregating the brokerage experience. We're taking it and saying, here, it's open and it's available. We're empowering innovation.